This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril Hong in Singapore. The top stories this hour. Asian stocks set for a cautious open to a week dominated by central bank decisions, including a likely cut from the Fed. The durability of the AI rally also in focus. China-Japan tensions ramping up with claims a Chinese fighter jet locked radar on Japanese military planes. And we look at the mega deal set to reshape the entertainment business with streaming pioneer Netflix buying one of Hollywood's oldest studios.
We're taking a look at the Japanese yen in today's session. After we saw some strength against the U.S. dollar, we had seen more signals coming from the Bank of Japan that they're ready to hike rates this month. Although Goldman Sachs now coming out and saying one rate hike will really not make a difference when it comes to the Japanese yen's underperformance. We still are watching wage data, GDP data out of Japan today. Of course, a very important week when it comes to policy decisions around the world. We mentioned a potential rate cut coming from the Fed. We do have decisions out of Turkey, Brazil, Switzerland, and also Australia. The RBA is expected to keep rates on hold. The ASX 100 at the moment down 0.3%. Early in the session, of course, is staggered open. We had already seen the RBI in India lowering their benchmark rate for the first time in 6 months, Avril.
Yeah, to your point about this being a consequential week for central bank decisions when it comes to the Fed. Yeah, consensus is 25 basis points, but we're watching for any dissenters that are calling for 50 basis points at the time when the U.S. Central Bank is still dealing with a data backlog. So from December's meeting, this week's meeting, where do we go from here? And what's interesting is how, despite the Fed cutting so far, we've been seeing these upward pressures on U.S. Treasury yields, something to watch this week as well. We're seeing the dollar, it's faring pretty mixed against its G10 peers for the moment. We are also seeing that cryptocurrency is hovering just around the 90K handle. Shery.
Yeah, we're also watching the Chinese yuan. We have seen significant strength. We are getting data this week. November trade data due today with exports likely rebounding despite shipments to the U.S. remaining soft. China's latest consumer producer prices on Wednesday expected to show deflationary pressures remaining entrenched with just a modest rise in CPI along with a slightly smaller producer price decline. Australia's central bank likely to keep rates unchanged after strong CPI reading. Bloomberg Economics seeing the RBA resuming cuts next year. And most economists expect a quarter-point interest rate cut from the Fed on Wednesday in the U.S. That's despite growing unease among fellow policymakers that inflation remains too high. Treasury Secretary Scott Bessent says he believes the economy is strong despite the impact of the lengthy government shutdown.
The economy has been better than we thought. We've had the 4% GDP growth in a couple of quarters. We're going to finish the year, despite the Schumer shutdown, with 3% real GDP growth.
For more on what to expect this week, let's bring in AMP Deputy Chief Economist Diana Mousina. Also with us is Asia Markets Executive Editor Paul Dobson. Diana, let me start with you. Are you expecting a rate cut come from the Federal Reserve this week, and what are the implications for Asia?
I think we will see that cut from the Fed, and it's basically to avoid any unnecessary downward risks on the US labour market, because some of the signals around initial continuing jobless claims, the trend up in the unemployment rate, points to the risk that the unemployment rate goes higher in the US next year. And I think the Fed wants to avoid that as much as possible. And while inflation has trended up a little bit, I don't think it's enough of an increase to really concern the US Fed that inflation's on an unsustainable increase into 2026. So I guess as an insurance policy for the labour market, we're likely to see that cut this week.
Paul, let's bring you in here because it's interesting, right? This week is baked in. Where does it go from here? I think is the key question. But at the same time, we are seeing these upward pressures on yields. So to what extent and what is it going to take to bring those yields down?
Yeah, so well, I guess it's the shape of the curve that's really in play here. So while shorter term yields have been falling, it's the back end of the yield curve that has seen interest rates rise, even though the Fed has been cutting interest rates. You see about a 50 basis point lift, I think, on the 10-year since the start of this latest cutting cycle. cycle, 80 basis points on the 30-year. So it really talks to that idea that it's the long-end rates going up. And there's a couple of reasons for that. Well, several reasons for that, depending on who you speak to. One, Fed cutting, doesn't necessarily do much for inflation. So there's some risks about the idea that inflation is still not fully under control. That's pushing up back-end yields. Also, there's those continuing concerns about just the credibility of the Fed. If indeed the chair Powell is replaced by someone who is more dovish, and that puts in place a monetary policy where they're a bit more open to higher inflation and running it hot, then again that sort of is bad for the back end of the yield curve. Then there's just simple demand-supply dynamics as well. You've got governments all around the world setting more debt and setting more long-term debt, and so the market is worried about all of those three things. So that's been pushing up the back end of the yield curve. But I thought interesting, you heard those comments from Besant speaking over the weekend. He went on to say, so far we've got we've got interest rates down. Now we need to turn our attention to inflation. And so there's a government effort as well as a monetary policy element to that. It's sort of designed to pull down those longer-term rates over time.
Paul, is the Fed in the driver's seat again when it comes to the markets? Because, of course, we have seen the rally in artificial intelligence. Take a look at this chart, because any company exposed to OpenAI has surged more than 70%. What's interesting now is that companies exposed to Google, to Alphabet, are actually outperforming those exposed to OpenAI. You're seeing a little bit of a shift even within the AI narrative right now. What's going to move the markets?
Yeah, so I think that's really interesting. It's about differentiation between the various AI stacks in some ways. So OpenAI had been seen to be in the lead and sailing away. Now we have the Google making a comeback, and so all of the companies that are related with that supply chain have been picking up and gaining ground recently. For us, have a look at the Chinese companies. We saw that IPO on Friday of more Threads, absolutely blowing through expectations as well. So that's another competitor that might chip away. And so I think you see this rivalry developing around the AI world. Is no longer a homogenous block, which is interesting, but I don't think that it takes away from the whole AI narrative overall for the equities market. That's definitely still going to be a major theme into next year.
We continue seeing this continuation. We are looking at how the market leadership keeps shifting. Diana, let's bring you in here on this. How do you see AI affecting economies in 2026?
Well, I guess the hope, of course, is that we see more of a productivity boost from all the investment that's been going on into AI. My question is whether that comes in 2026 or later. I think it's going to be more of a longer-term trend. At least in the next 6 to 12 months, I think we are going to see further investment into AI areas, particularly around things like data centers, and that's going to provide this floor or this boost to GDP growth in the developed world in the next few years, I'd say. And then longer term, it's really waiting for that productivity turnaround, and economists are questioning now how large that boost of productivity growth is. Of course, we'd like it to be quite decent, particularly in a country like Australia, where we have had quite low productivity growth in the last few years. The US has been a bit of an exception to that. Hopefully it can offset some of the weakness in productivity growth here that's been related to areas like mining and the non-market sector. But I think it's going to take a few years before we actually see that boost, and also before we see the very widespread boost to all companies and consumers from more AI. Hopefully it helps as a deflationary pressure as well in the very long term.
So, Diana, in Australia, we're not necessarily expecting a rate cut from the RBA this week, but are we expecting cuts to come next year, given, of course, the challenges that you mentioned?
Well, it's interesting that now we're talking about the potential for rate hikes in Australia, which seems a bit crazy to me, given that we've only really in the middle of the cutting cycle here in Australia, and we've had fewer rate cuts here compared to some of our global peers. The reason that there's all this talk about rate hikes recently is because some of the data has been a little bit stronger than we've been expecting. So we've, of course, had the uptrend in monthly inflation data now for a number of months. The GDP GDP figures have been a little bit stronger. The consumer, I suppose, is seeing this slow turnaround. The labour market hasn't deteriorated as fast as expected either. So from a policy point of view, I think it does make sense that the RBA is on hold from here. I mean, the market's always quite fast to move, and just as quickly as it's been pricing in rate hikes, maybe we can see that completely shift if we get a bad labour force print, which we are getting the labour force data this week. I think the market will be quite sensitive to any news that the unemployment rate is headed up from here. We at AMP think that there's more risk of a cut in 2026 than there is the risk of a hike. We think that the market pricing for a rate hike by the end of next year is just way too premature. And the most likely outcome, in our view, is that we just have a period where rates are on hold for quite a long period of time for the RBA. That, of course, seems a little bit boring, and maybe that's why the market doesn't want to price in a period of holds, and that's why they're pricing in this risk of a hike next year.
What about what you're seeing in terms of trade, particularly with China for Australia and the exports picture? How is that shaking out into 2026? We also have China trade data that's due later today.
Well, what I've been looking for is to see any potential impacts from US tariffs, if we've seen any deflationary impact to Australian imported goods from overseas, in particular from China. We haven't really seen that yet. I don't know if it's just been a bit of a delay, if we're likely to see more of that into 2026. I do think that generally in the next 12 months, that's going to be another deflationary pressure for goods coming into Australia, that we get some of the deflation that China has had helping Australian goods prices, and of course some of the impacts from tariffs as well. But we've still seen quite a lot of demand for Australian commodities that are getting exported out to China. LNG, coal. Of course, coal has been on a long-term decline from a trend point of view, but there's still plenty of demand for Australian iron ore. It's very high quality, and there's still a lot of that support coming from China. So I wouldn't say that the story has really shifted too much there. It would be good to see stronger services export, so more Chinese visitors coming into Australia, particularly for education and tourism. That still hasn't recovered to its pre-COVID levels.
When it comes to the Chinese yuan, though, we are seeing significant strength. Paul, this is not necessarily an issue for the PBOC, but we have seen with the weakness of the U.S. dollar, some other economies like Switzerland, for example, suffering from a very strong franc.
Yeah. There's, so any reason to buy the Swiss franc, everybody's looking for it again. And indeed, over the weekend, we heard a lot of comments about people worried about the weakness of the structures in Europe, which just continues to flow more money into Switzerland, for example. But I think you're right. The weaker dollar is starting to become a little bit more of a story that people are cottoning onto. It certainly caught our attention last week with the Chinese yuan and the fixing, where the PBOC really kind of slammed on the brakes a little bit, or at least, adjusted the speed with which the currency has been appreciating. It still looks like we're on that course towards 7, but just very, very gradually and slowly. And perhaps, nobody really minds that all that much. And on the flip side of that, some of the rest of Asia's FX markets may actually get a little bit of relief from the idea that the dollar is coming down. We've been seeing stuff like the Indian rupee, for example, under a great deal of pressure from its side. So if the dollar does adjust lower, then that should help the RBI, for example.
Paul, Diana, thank you so much for your insights, setting us up for what could be a really consequential week for both economies and markets. AMP Deputy Chief Economist Diana Mousina and Bloomberg Asia Markets Executive Editor Paul Dobson. We have more ahead on the Asia trade. This is Bloomberg.
Tensions between Japan and China have intensified over the weekend, with the two countries giving conflicting accounts of an incident involving fighter jets near Okinawa. For the latest, let's bring in our chief North Asia correspondent, Stephen Engel, in Hong Kong. Steve, what happened?
Well, obviously, this is the hazard of the tensions increasing and neither side really backing down. So there could have been a bit of a disaster, obviously. But the interesting part of this is the two sides have, as you rightfully said, Shery, conflicting accounts of what actually happened. So I can give you both accounts. Now, the Japanese essentially says they scrambled their fighter jets, the F-15 fighter jets, when they indicated there was indications that Chinese J-15 fighter jets had come close to Japanese airspace. Now, the Japanese says this incident happened over international waters. They scrambled their F-15s, and then that's where we get into the Chinese account. The Chinese account says the Japanese F-15 fighters essentially disrupted their training that they were conducting in international waters off one of their aircraft carriers and created an unsafe environment for their training. So again, the Japanese account says they basically, the Chinese had done fire control radar. They locked in on the Japanese jets on two different occasions on Saturday morning and then Saturday afternoon. Now, this is what the Chinese Foreign Ministry in a statement says. Under the current circumstance, the Japanese side, by hyping up the so-called issue of radar illumination, that is essentially fire control radar, locking in on the jets. They're claiming that Japan is hyping this up, is deliberately making a false accusation against China to build up tension and mislead the international community. It is purely ill-intentioned, according to the Chinese. Now, Takaichi-san, the Japanese prime minister, said this is an extremely unfortunate situation. We strongly protested to China and demanded measures to prevent any reoccurrence. We will respond calmly and firmly. But again, the Chinese have a different account of that, and they still are demanding an apology from Takaichi-san regarding her comments last month regarding Taiwan, and also a retraction of those comments. So far, Tokyo has stood firm.
Stephen, thank you so much for the latest on this escalation between China and Japan and on this military encounter with no end in sight being seen in tensions between the two North Asian superpowers. Chief North Asia correspondent Stephen Engel for us. Meantime, we're also tracking trade-related developments. India's tariff talks with the U.S. will pick up this week with visits from a senior State Department official and a team of American trade negotiators. For more, Bloomberg's Asia-Pacific economy reporter Swati Pandey joins us from Sydney. Swati, good to see you. How much closer are we when it comes to a US-India trade deal of sorts? And seeing how economists are factoring in a slowdown for the Indian economy, how much does it need this?
Good morning, Avril. Look, it's very hard to say how close the two countries are. Negotiations have been going on for a very long time. And there are some sticky points, including India's relationship with Russia and the purchases of oil from Russia. And those sticky points remain. We will have a visit from the U.S. Trade negotiators to India this week. And hopefully they will be able to iron out some of those differences. The 50% rate that India gets at the moment is very high, it's very steep, and like you mentioned, it is affecting the exports to US, which happens to be India's biggest market. Yes, economists are expecting a slowdown in India's growth rate, which is a stellar 8%. So there is definitely a need for India to resolve those differences. Whether it happens in this particular visit or whether more visits are needed is yet to be seen.
In the meantime, Prime Minister Modi seems to be boosting ties with Russia. India just clinching a $2 billion submarine deal with the country. How significant is this?
Shery, this is significant on the face of it, but if we actually look at the relationship between the two countries, there's not a lot to offer for India to Russia and vice versa. So this particular submarine that we are talking about had been in talks. The negotiations for it had been on since pre-COVID times, and finally they have been able to clinch this deal. And it will not be used in a war. It will only be used for training the Indian Navy and will be returned in 10 years' time. So in that sense, is it very significant? I'm not very sure about that. And they have spoken about a multifaceted relationship between India and Russia when Putin was in town a couple of days ago. They have spoken about an aspirational $100 billion trade deal. But again, it was lacking in detail. What does this trade deal really mean? What is India offering to Russia? What is Russia offering to India in return? India had signed a deal for S-400 missile system with Russia, again, pre-COVID. 5 of them were supposed to be delivered. Only 3 were delivered. 2 are still waiting. And so there are a lot of those issues as well. So the relationship between Russia and India seem to be about pride and pageantry on the face of it, but it's really about seen as a hedge against other countries. So in that sense, the two countries will continue to be close, but in actual real terms, whether there is much in it, I'm not very sure about that.
Swati, as we continue to watch these geopolitical dynamics, the trade backdrop, you alluded to some of this about how the Indian economy could really use a deal when it comes to tariffs with the U.S. What is the extent in which economists expect the RBI's dovish trajectory to offset some of this?
Yes, so the reason the Reserve Bank of India cut interest rates last week was because inflation was low. In fact, Governor Sanjay Malhotra called India's economy a Goldilocks economy with very strong growth and low inflation. So the projection is now for growth to slow down a little bit, but India's domestic demand is really strong, and that strength is likely to continue. He also called on exporters to look to diversify markets and look at other countries for exports. Obviously, it's very hard to diversify completely out of the U.S., so that impact will definitely be there, and the impact from slowdown of exports to the U.S. will have an impact on growth. But again, the projections are still for growth in that 7% ballpark, which is quite strong as far as the broader Asia-Pacific region is concerned. The other big hit that India has taken is in the form of the rupee, which is the worst performing currency in the region. And with the Reserve Bank cutting interest rates and predicting that there could be further cuts, it doesn't look like there is much upward for the rupee from here.
Bloomberg's Asia-Pacific economy reporter Swati Pandey there with the latest on India. We have more ahead on the Asia trade. This is Bloomberg.
Here are the top global headlines we're following. French President Emmanuel Macron has warned that the European Union may be forced to take what he called strong measures against China if it fails to address its widening trade imbalance. In a newspaper interview, Macron said the EU could be obliged to decouple and mentioned tariffs as a possibility. His remarks follow a 3-day state visit to China, where he pressed Beijing for more investment. U.S. Trade Representative Jameson Greer says China is holding up its end of the bargain on trade commitments. This comes less than 2 months after Presidents Trump and Xi agreed to extend a tariff truce. We have more ahead on the Asia trade. This is Bloomberg.
We have breaking news out of Japan. We are having the labor cash earnings year-on-year growth of 2.6% for the month of October. This is coming above economists' expectations, also accelerating from the previous month. And this, of course, as we continue to watch that potential BOJ policy rate hike come this month. We have seen the annual minimum wage increase plus a tighter labor market helping accelerate those gains when it comes to wage growth in Japan for the month of October. It's also boosted non-regular workers. So we are expecting that 25 basis point rate hike this month from Bloomberg Economics as we're getting the labor cash earnings year-on-year growth exceeding expectations with growth of 2.6%, Avril.
Now, Shery, the other thing we've been watching also is some M&A news, including one of these largest ever media deals that are shaking up or set to shake up the entertainment industry with Netflix set to take up Warner Brothers. And of course, some of the details that we know about this deal is that they'll receive $27.75 a share in cash, these Warner Brothers shareholders, and stock in Netflix. So this would value the business at around $83 billion, including debt. Now, to some, there's been questions lingering about why Netflix made this move. But don't forget, Warner Brothers has a deep library of programming, which includes HBO, and Warner Brothers assets include those in studios in Burbank, California. So might this give it an edge over Disney and Paramount? This edge for the streaming giant in particular, buying up one of Hollywood's oldest studios. Certainly we heard from the Netflix president weighing in on this. Take a listen.
I know some of you are surprised that we're making this acquisition, and I certainly understand why. Over the years, we have been known to be builders, not buyers. We already have incredible shows and movies and a great business model, and it's working for talent, it's working for consumers, and it's working for shareholders. But this is a rare opportunity, and it's going to help us achieve our mission to entertain the world and to bring people together through great stories.
And you mentioned it, Avril, this is a huge deal. We're talking about 450 million subscribers combined. So we are expecting heavy regulatory scrutiny. President Trump already commenting on this, saying that the Netflix and Warner Brothers deals has to go through a process. He's now saying that this company, Netflix, is great, but the proposed deal, it entails a lot of market share, and it's up to the board to decide on the Netflix Warner Brothers deal. We know that the co-CEO of Sarandos met with President Trump at the White House in order to discuss the auction of Warner Brothers, arguing that Netflix isn't a monopoly. He made the case for his company's offer to buy Warner Brothers, but with Trump reportedly saying that Warner Brothers should sell to the highest bidder, and we are now hearing his comments publicly saying that this should go through a process. You see the stock of Warner Brothers Discovery right there, year to date, a gain of more than 140%, of course, with expectations of where this could go from here. Right, take a look at some of the other stories that we're following on the corporate front as well. Apple undergoing its biggest personnel shakeup in decades, with senior executives and key engineers leaving the company. In the past week alone, the heads of AI and interface design have stepped down, as well as the general counsel and head of governmental affairs. We're also told Apple's senior VP of hardware tech, who runs their in-house chips effort, is considering leaving. Shares of DigitalBridge surged Friday in New York after Bloomberg revealed that SoftBank is in talks to acquire the company. DigitalBridge is a private equity firm that invests in assets such as data centers. Sources say a transaction could come together in the coming weeks, though deliberations are ongoing and there's no certainty of an agreement. Take a look at how we're setting up for the Chinese market opens. A50 futures finishing to the upside of 0.4% as we continue to see strength in the Chinese yuan. This, of course, as we also seeing some weakness in the U.S. dollar for the last 2 weeks. China has won back global funds in a banner year for stocks, with investors anticipating further gains on the country's AI prowess and resilience amid U.S. tensions. Fund managers are expecting this strength to extend through 2026. Our Asia Equities reporter Winnie Su is in Hong Kong with more. Winnie, what can we expect this week, especially given that we have more data coming out today as well?
Yeah, morning, Shery. It seems like, the expectation right now for Chinese stocks is really ramping up, especially around foreign investors. Yes, we do have a lot of data that's going to keep us very excited in terms of how the economic outlook is going to look like, because that's a lot of focus that investors are putting on. So when we talk about kind of just the outlook that they have, yes, near term, it still is going to be based on that upcoming data, because actually last year, we've got that very weak data when it comes to the PMI service data front. So a bit of a concern in terms of if the economic recovery can really keep up with the market's rally. So a bit of a wait and see there. But overall, longer term, it's still a bit of a bullish outlook that we're hearing from investors.
Winnie, you alluded to some of this. What are the risks to that view? What might derail this?
Yeah, so obviously over the weekend, we also hear kind of how tensions are faring up between China and Japan again. So that on the political front, it seems like there is still a bit of a concern when it comes to the geopolitical tensions, whether it's between China and Japan or China and the U.S., for example. And some of the concerns, again, here is around the earnings front, because we actually didn't see kind of the earnings improvement as much as what analysts were expecting for the latest quarter. And also, like I mentioned, the economic recovery picture also is not as bright at the moment. Yes, we're talking about the longer term outlook being bright from the likes of, Man Group, Fidelity, expecting more gains. However, this time around, it seems like the expectation is a bit of a slow bull run, as we expect, for example, Morgan Stanley, just about 6% upside from the current level for the MSCI China, and Nomura about 9%. After that 30% gains of MSCI China so far this year. So it seems like there is that optimism there, but still the expectation is kept a bit more moderate when it comes to the longer term, just because of these structural changes still yet to happen.
Winnie, thank you so much. Asia Stocks reporter Winnie Su for us. Now let's shift our attention to commodities as well. For much of this year, it's been about gold. You buy it regardless of what the market outlook or risk is. But it seems like copper and silver has been outpacing that commodity, the precious metal, as the hot metal trade that heading into 2026, traders are really watching and being bullish about. And we are actually seeing institutional retail traders positioning for record rallies. Now, some of this has to do with the supply squeeze for silver that we saw not so long ago. Silver has, it's worth noting, nearly doubled so far this year. And we've also been seeing surging demand from India and silver-backed ETFs as well. Copper also, as I mentioned earlier, looking like a really hot trade with those industrial applications. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how the Japanese yen is trading after a week of gains against the U.S. dollar. We have seen more reports that the BOJ is ready to raise interest rates this month. In fact, the two-year yield now trading at the highest level since 2007. Although we have heard from Goldman Sachs that one BOJ rate hike is not necessarily enough to end the underperformance of the Japanese currency. We're also digesting some latest data, October labor cash earnings beating to the upside. We're also expecting third quarter GDP growth numbers to come out in just a few minutes. For more on the state of the Japanese economy, let's bring in our Tokyo economy and government reporter, Erika Yokoyama. Erika, should we go through the labor cash earnings first?
Sure. So I think today's data overall suggests that the pay momentum has been sustained and pretty stable. And especially if we look into base pay and nominal pay both rising over 2.5% from the previous year. So I think that will give the reason for the BOJ to just move ahead with the rate hike in December rather than waiting any longer. But as you just suggested, I think the focus now is whether this momentum can be sustained or last, because it's going to affect whether the BOJ can, whether and when the BOJ can raise interest rate next time after the expected move in December or January at latest. So far, today's data also pointed to some concerning elements. Real wages are still falling, extending decline to 10 months, and also there is widening gap between small farms and large farms. So these issues need to be addressed before the BOJ start considering another hike next year.
In the meantime, between now and the meeting next week, we will also have very shortly these refreshed GDP numbers out of Japan.
Correct. We will soon have a revised number. The initial reporting last month showed that the Japanese economy contracted for the first time in 6 quarters during the summer period as the Trump tariff hit exporters pretty hard. The revised figure will incorporate some data that came out after that, and economists are largely expecting a deeper contraction as the business spending will likely be revised down. Actually, these numbers will justify Prime Minister Takaichi's economic package, which ended up the largest since the pandemic restriction are eased. And that the confirmation of the contraction may give additional reason for Takaichi to do additional spending down the line as well. Then this is a slightly concerning situation, as you know, it's going to add the pressures on yield at the time when the rising concern. The concerns are rising about the fiscal sustainability, and higher yield may probably make it slightly difficult for the BOJ as well to stay on the tightening path going forward.
Our Bloomberg Tokyo economy government reporter Erika Yokoyama here with a breakdown of what we're seeing in the Japanese economy. But let's bring in Hiromi Ishihara, head of equity investment at Amundi, Japan. Hiromi, great to have you in the Tokyo studio as well. Given, of course, the challenges that Erika is talking about, especially when it comes to potentially more stimulus coming from Takaichi in order to counteract these pressures on the economy, how do you trade this market?
Overall, I think it's we remain constructive in Japan equity and Japan economy to some extent. The fundamental is very strong, and especially while we are monitoring the capex trend, even though there's still a lot of planning ongoing, and then it's the implementation of the capex itself is relatively weaker than planned. But I think it's all on the track, and I believe that cash earnings, retained earnings in Japanese corporates are record high, which should also address that the constraint of supply side, like labor shortages, etc. The company really encouraged to spend more cash on capex. So I think it's still it's very positive in Japan.
Broadly positive, but what about different sectors? Because if you take a look at this chart and you see the Nikkei topics ratio, for example, it's been interesting that the momentum seems to have shifted from the large exporters to perhaps more domestically focused stocks.
Indeed. So we're still positive on exported to some extent. Of course, the tariff impact was it's largely less than expected. But also, as I was saying, that the capex is going to be a key focus area. So it's certainly domestic area, especially as mid-cap plays. It's a beneficiary of more capex spending. So industrial, for example, is really interesting area to look at.
Hiromi, I wonder as well, in your mind, what else is left that needs to be accomplished when it comes to governance and reforms, and how might that translate in terms of the numbers into valuations and earnings next year?
So it's already, when the Tokyo Stock Exchange addressed the actions for the corporates, especially trading below book value, since then we have material the progress, like for example, compared to the number of trading below book value versus 2023, and then it's at the current level, it's substantially decreased of the numbers of trading below book value. But we definitely need to see more fundamentals. So the capital efficiency, for example. So PBR certainly increased over the last 2-3 years, but it's mainly driven by PER, so earnings and expectation basis, but not driven by ROE. So certainly we need to see more improvement in ROE side.
We're also seeing this trend, the fall of the number of listed companies. What is that meaning for the overall Japanese market and how it might affect the way foreign investors view it?
So the declining the numbers of listed companies, the current trend I see as healthy consolidation. One of the issues that we have had in Japan equity space is just too many companies, too many micro-cap companies are in the market. And then it's actually those of them are out of the investable universe, especially by foreign investors. So the decline in the numbers itself is actually, it's a better capital allocating to, the limited universe. So it's a positive. But also, since the governance reform, I think, being listed is not always the optimum option for every company. So it's certainly for those who decided to stay, requested to have higher governance standard, higher capital efficiency, and then also it's more stakeholder-oriented management. So definitely listing cost is getting higher, but it should translate into the higher quality of Japanese equity itself. So I think it's really a positive sign of that.
Yeah, I was speaking to the Japan Exchange CEO last week, and he was talking about how he expects more activist investors to also come into the Japanese market, but that they're not necessarily a dominant force yet in Japan. Do you expect to see that change, and what sort of implications does that have for the broader levels of the Japanese market?
So it's certainly, TOB and M&A are picking up in the last 2 years, and I think the trend is going to continue for, the next year ongoing forward as well. And the broad implication is that, of course, parent and child subsidiary dual listing is the main big governance issue, and I think it's positive trend, TOB implemented by parent companies. But also M&A and also some activism activities, also it's a great challenge for the corporates to understand and increase the awareness of governance issues. So I would say the broad Japanese equity implication is also positive.
When it comes to the depreciation of the Japanese yen, that has implications for the markets, of course, especially the speed of depreciation or appreciation, depending on where we're going from here. What's your base case for the yen into 2026?
So I believe that the weak yen is structural. So I don't think that we further expect the dramatic appreciation of yen in 2026. Even though I think the late hike is sort of on the track, and then we should expect to see. I mean, of course, need to wait for another comment from BOJ, but it's certainly current given the inflation going to be sticky. So the BOJ should also consider, the putting higher downside floor of the neutral rate. But I think, the yen structurally remains weak.
We are now expecting those GDP numbers to come out any time now. Right now, annualized quarter-on-quarter contraction of 2.3% for the third quarter. And these are the final numbers for Japan's GDP. Nominal quarter-on-quarter contraction of 0.1% for the third quarter. These are the final numbers that we're looking at right now. The contraction for both the annualized and the quarter-on-quarter headline number are bigger than economists had expected. And this, of course, coming at a time when in the third quarter we were still contending with those U.S. tariffs on Japanese imports after we got that after we got that agreement, we are going to continue to watch whether sentiment improves among Japanese corporates. But again, annualized quarter-on-quarter contraction for the third quarter final of 2.3%. And Hiromi, just a reaction for you. I mean, are we expecting the numbers to get better given that we have some sort of deal with the U.S., and could that have implications for the markets as well?
I think so. So it's certainly, there were the company's activity have been suspended for quite a while just to wait and see what the tariff negotiation is going. So it's now we have more visibility of the tariff. So the company's activity should resume. And then also given, the solid fundamentals in the U.S. economy overall, we should expect to see the pickup going forward.
Hiromi Ishihara, good to have you with us, Head of Equity Investment at Amundi, Japan, of course, as we continue to watch the reaction when it comes to the Japanese economy to those tariffs and, of course, the monetary policy normalization from the BOJ. Catch Japan Ahead every Monday at 8:40 a.m. If you're watching in Tokyo, subscribers can watch live on the terminal using the TV Go function. More ahead, this is Bloomberg.
And we have breaking news crossing the terminal. We always knew this was a sort of possibility given the size of the deal involving Netflix and Warner Brothers. We're hearing from the U.S. president speaking at the Kennedy Center, talking about how this deal could be a problem. And he's raised potential antitrust concerns for Netflix's planned acquisition of Warner Brothers, specifically noting that the market share of the combined entity may pose problems. Netflix has, of course, argued that it wasn't any kind of all-powerful monopoly. And this is contrary to the claims of rival bidders, including Paramount, which is, of course, controlled by the Ellison family. Shery?
And take a look at how we're setting up for the market opens across Japan, because we just had data showing the third quarter GDP contracted more than expected and annualized 2.3% quarter on quarter. The estimate was for only 2%. It's been really revised down in this final number. Of course, we have seen capex also falling in the third quarter, really reflecting perhaps the concerns around the U.S. tariff impact, which, of course, in the third quarter, we had still seen the consequences and fallout, given that we just got that deal achieved around the summer. We were also digesting the labor cash earnings numbers, rising 2.6% and beating expectations. We had expected wages growth to accelerate, given that the annual minimum wage was increased, and we're continuing to see a tighter labor market. The Japanese yen holding at that 155 level. Nikkei futures pointing to some upside of 0.6%. The big news is more reports of the BOJ potentially hiking rates this month. Bloomberg has launched its new Japanese website. Do visit bloomberg.com/JP for more exclusive Japanese language reporting and curated features from our global newsroom. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is Asia Trade. We're counting down to Asia's major market opens ahead of a busy week headlined by the Federal Reserve. Avril, a cut is expected from the Fed, while we're also expecting holds from other central banks like Switzerland, Canada, also the RBA. And this, of course, coming after already a rate reduction from the RBI, the first lowered since about 6 months ago.
Yeah, so the focus is also going to be on central bank policy on top of what it comes to market leadership in these AI front runners when it comes to the likes of OpenAI and how you've seen those companies tied to it. It's sort of moved from a boom for them into a bane. What does this mean for the stocks and the companies that are tied to Alphabet? That's something else to watch in the session as well.
Yeah, we're watching SoftBank as well here in Japan because, of course, we continue to see its AI bets and now expected to perhaps invest in Digital Bridge, which is a PE firm which invests in data centers. And we're watching that stock at the open as we're seeing the Nikkei now gaining 0.3%. The big news here in Japan is a potential rate hike coming from the Bank of Japan as well. That could happen as soon as this month. The topic's gaining 0.25% at the moment, and the Japanese yen holding at that 155 level. We're still digesting eco data, perhaps backing that potential rate hike. We had labor cash earnings for the month of October, surprising to the upside, although third quarter GDP numbers were revised lower, a contraction of more than 2%. Not surprising, very backward looking, and also we are following the impact of the U.S. tariffs. That 10-year yield holds at that 195 level, the 2-year yield already at the highest level since 2007. Take a look at how Korea is coming online because the Kospi was already trading at the highest level since mid-November or so, and you can see the Kosdaq also gaining ground at the open. The Korean won holding at that 1472 level. We are expecting job numbers out of South Korea this week as well.
Shery, for U.S. assets, it's really about this data backlog as well that is causing the bond investors to be a bit uncertain about the Fed trajectory. So you're seeing that continued upward pressure when it comes to yields, despite the Fed having already been cutting. Where do we go from here? Take a look as well at what we're seeing in U.S. futures after last Friday's close. We're not giving much direction when it comes to what it comes on the equity space. We are also watching out for the moves on the dollar. Of course, given how things look pretty range-bound, I suspect that's the way it's going to be until we get the Fed decision. Mark Matthews is head of Asia Research at Julius Baer. He joins us now. So, Mark, let's start off with the trajectory of the Fed. What are you expecting this week? I mean, 25 is baked in, but what else are you expecting to hear from the U.S. Central Bank?
Well, everybody wants to see how hawkish of a cut it is because we know there are a lot of dissenters. I can count basically 6 out of the 12 voting members of the FOMC who expressed some concern over inflation. And so we'll have to look at how many dissenters there were and how Chairman Powell handles the Q&A session to see how guarded they want to be about further rate cuts going forward. But for the record, we still expect another rate cut in January and then one more in March.
What is this going to mean for Asia currencies, including the yen? There's some expectation that the BOJ will have to hike and then keep hiking for us to see more sizable appreciation in the currency.
I think that's probably right because they have a significant balance sheet they can also offload to help tighten monetary policy. So we are looking for a rate hike in Japan this month. Then we're looking for one more in June next year. So that would take them up to policy rate of 0.75%, which still leaves real rates deeply negative because their inflation is at 3%. So I would expect some appreciation in the yen, but I wouldn't expect it to skyrocket. And if you compare now to that last time there was a surprising change in the BOJ and a big reversal in the yen, there were a lot of short positions back then that needed to be covered. And now, in fact, people are on average slightly long the yen.
Yeah, that's a good point, right? Because what we saw in July of 2024 was that crazy unwind when it came to yen carry trades. And in fact, that even hit U.S. stock performance. Will there be any implications from what the Japanese policymakers do here in Japan for global markets, especially given how sensitive global bond yields have been to JGBs?
I don't think so because I still think that Japanese investors will want to keep a healthy exposure to U.S. Treasuries. And so I know they own over $1 trillion of them. But as I said, if the policy rate in Japan is only 75 basis points in June of next year, then I'm not expecting the Japanese government bond yields to skyrocket further. And where they are now, I would say, is actually reflective of a healthy economy. I know there's great consternation around how quickly they've gone up, but I think Japan is in a much better situation today with some decent inflation and some decent growth than in the decades past when they had very little of either.
Mark, we have plenty of central bank decisions to go around this week, including the RBA. Of course, we had the RBI cutting rates as well on a week where we have plenty of eco data, China trade data out today as well. Is there anything in particular that you're watching for more momentum or catalyst when it comes to Asian markets?
Yes, I am watching the RBA. It is our favorite bond market in Asia, and the reason for that is you get a much higher yield in Australian investment-grade corporate bonds than their U.S. peers. If memory serves me right, it's about 5.5%, and their inflation is high. I think it's over 3%. Their unemployment is very low, and their private sector is doing very well. There's a lot of confidence in the economy, so I don't think the RBA will cut, and I think that will provide stability to their currency. So we're looking for the Aussie to be about 5.5% higher 12 months from now versus U.S. dollar. And putting all that together, I think it's a very good environment to invest in corporate bonds.
The thing of the RBA is also that I think investors are watching to see how hawkish they are. There had been chatter not so long ago about a prospective hike. Is that something that you're putting in the calculus? How might that put risk to your existing view?
We're not expecting a hike in Australia, but we should watch the inflation rate because it has been rising for the last 4 to 5 months and also been above expectations for the last 4 to 5 months. So I guess if their economy really gets a big head of steam, that they would need to raise rates. But right now, it's not in our forecast.
One of the economies very closely tied to China's economy, of course, is Australia. When it comes to what you're seeing among tech, AI leadership, what is the, I guess, risk to the view, given how these things we've seen in the past 2 years, they shift very quickly. We've gone from OpenAI to Alphabet. What is that going to mean for Chinese tech investment?
Well, it's a different ecosystem, of course. So they do have artificial intelligence, they do have large language models, but in China, you're also talking about advanced manufacturing, robotics, and biotechnology. And so what I think is interesting is how quickly they're picking up market share around the world with their technology. And that has implications for their currency because the more they sell those things overseas, the more money will be repatriated to China into the renminbi. And so I think actually the renminbi will be trending up over the next few years as they increase their global market share in these products and services that they're very competitive in.
Mark Matthews, Head of Asia Research at Julius Baer. Always good to have you with us. And of course, we're talking about artificial intelligence and these big bets on these products. Well, SoftBank making a big bet, potentially buying Digital Bridge. This is a PE firm that invests in assets such as data centers, and sources speaking to Bloomberg saying that SoftBank wants to take advantage of that AI-driven boom in digital infrastructure by acquiring Digital Bridge Group, this PE firm that invests in data centers. We're seeing the stock falling more than 2.5% early in the Asia session. More ahead. This is Bloomberg. Take a look at how Japanese assets are trading at the moment. Real estate and energy gaining ground, while communication services and consumer discretionary stocks are leading the Nikkei lower by 0.4%. The 10-year yield now trading at that 195 level. We're seeing a little bit of divergence with the 2-year yield under a little bit of pressure after touching that 2007 high, while long-end yields continue to gain ground. We have seen, of course, expectations of the BOJ hiking rates this month as we are getting the latest labor cash earnings surprising to the upside. Third quarter GDP numbers, though, being revised lower. For more on these latest eco readings out of Japan, we're joined by senior editor Brian Fowler. Brian, so let's talk a little bit about the labor cash earnings, because wages seem to support this idea that the BOJ should hike rates.
Yeah, Shery, that's absolutely true. I think first of all, we had the nominal gains, which have been very steady, and that's a positive sign for the BOJ. On the other hand, we saw real wages fall for a 10th straight month, but the problem there isn't the nominal wage gains. Those are steady. It's the inflation. So that's yet another reason why it makes sense for the BOJ to hike rates to try to put a cap on inflation. So I think overall, the wage data definitely support the case for a hike on December 19th and possibly for further tightening well into 2026.
Is that to say that we should be discounting what we got out of the third quarter GDP numbers?
Well, Avril, I wouldn't discount it. Those numbers definitely were a little bit bleaker than we expected, and they will add justification to Prime Minister Takaichi for the very large stimulus package that she announced last month. On the other hand, we've got all kinds of conflicting data. A week from today, you can see this on the Bloomberg terminal, we have the Tankan coming out. And we've already got surveys from economists showing that they broadly expect business sentiment to stay steady, possibly even getting a little bit better for large manufacturers. So the BOJ is going to be looking at all these figures, wages, the household spending we had last Friday, today's revised GDP, and, of course, Tankan next week. And I think, broadly speaking, while there are pockets of weakness, the trend remains fairly solid and certainly solid enough for the BOJ to hike rates. Of course, the BOJ will say that policy, even with the hike, remains accommodative. That's important to show that it's on the same page as the government. But I think all things being said, there's no reason not to go ahead with a 25 basis point hike.
To your point on being on the same page, I mean, for the last couple of weeks, we continue to get these signals coming from the government that they're not going to get on the way of a hike.
Yeah, exactly. So they could have. Anytime they could have said things to indicate that they were not in favor of the BOJ hiking. And from the government side, we haven't seen that. And also from Governor Ueda's side, he's given fairly subtle hints. He said, I'm working closely with the government, and we know that he met with Takaichi. The implication is that he explained to her what needed to be done, and she did not object, and he's basically said that he thinks that he's got the green light to do whatever he thinks needs to be done, and we think that means a hike.
Brian Fowler, senior editor here at Bloomberg, with the latest when it comes to Japan's eco data and a potential move by the Bank of Japan. Bloomberg has launched its new Japanese website, so do check it out, bloomberg.com/JP. You get exclusive Japanese language reporting, also curated features from our global newsroom. Now, on the geopolitical side, tensions between Japan and China have intensified over the weekend. The two countries giving conflicting accounts of an incident involving fighter jets near Okinawa. For the latest, let's bring in our chief North Asia correspondent, Steve Engel, in Hong Kong. Steve, what do we know at this point?
Well, obviously, this didn't become an international incident because no shots were fired, but it is the kind of incident that could, because of miscalculations or accidents, could absolutely ramp up the tensions between the two countries that are, of course, already at a heightened state because of those controversial comments by the Prime Minister of Japan, Takaichi-san, about Taiwan. That has angered Beijing, and Beijing obviously has demanded an apology and a retraction of those comments, which Tokyo has not done. So both sides are sort of standing their ground, and that's why this kind of military interception, if you will, could potentially have dangerous ramifications if indeed some deaths are involved or military aircraft are fired upon. But let me tell you what happened, and there's two sides to this story. Essentially, Tokyo says the Chinese J-15 fighter locked radar, basically fire control radar. So they trained in their radar on the F-15s of Japan, which had been scrambled because they saw these activities going on in international waters. But the fighter jets from Japan sort of intercepted the Chinese jets, which took off from the Liaoning aircraft carrier in international waters to make sure that those fighter jets from China would not cross into Japanese airspace. Anyway, this is the Japanese explanation of it from the defense minister. Let's hear from him.
This radar illumination was a dangerous act that exceeded the scope necessary for the safe flight of aircraft. We find it extremely regrettable that such an incident occurred, and we lodged a strong protest with the Chinese side, firmly requesting measures to prevent any recurrence.
Now, I said there are two sides to the story, because then you have to hear Beijing's response. Beijing, essentially, the Ministry of Foreign Affairs, has accused Japanese F-15s that were scrambled of disrupting air training done in international waters. And here's the comments. Under the current circumstances, the Japanese side, by hyping up the so-called issue of radar illumination, that is essentially fire control, locking in, training in on the Japanese jets, is deliberately making a false accusation against China to build up tension and mislead the international community. It is purely ill-intentioned. Essentially, the Ministry of Foreign Affairs goes on to say that the Japanese fighter jets approached and disrupt its training and gravely endangered flight safety. So we'll have to see where we go from here, but obviously this does not help diffuse, in fact, it doesn't diffuse at all, the ongoing simmering tension between the two countries.
Steve, thanks for helping us get up to speed with what both China and Japan are saying. Our chief North Asia correspondent, Stephen Engel. To some of our top global headlines as well, French President Emmanuel Macron has warned that the European Union may be forced to take what he called strong measures against China if it fails to address its widening trade imbalance. In a newspaper interview, Macron said the EU could be obliged to decouple and mentioned tariffs as a possibility. His remarks follow a 3-day state visit to China, where he pressed Beijing for more investment. U.S. Trade Representative Jameson Greer says China is holding up its end of the bargain on trade commitments. This comes less than 2 months after Presidents Trump and Xi agreed to extend the tariff truce, roll back export controls, and reduce other trade barriers. Greer also told Fox News they're keeping a close eye on Beijing's soybean purchase commitments.
With China, it's always we verify and we monitor and we watch the commitments. The commitments are quite specific. They're about purchasing, a certain amount of soybeans, for example, through the rest of this growing season and then each of the next years. These are things that are quantifiable. The data are clear. We've already seen that the Chinese are getting to about a third of the way through their purchase commitment for this growing season. Part of the other commitments they've made have been to ensure that rare earths and critical minerals continue to flow to the United States. That's something we monitor as well. It's never perfect, but it's all going the right direction, and we're seeing the kinds of flows that are keeping our factories open, keeping manufacturing going. So all of these things that we've agreed to with the Chinese recently are very concrete. We can monitor them with some ease, and so far we're seeing that they're in compliance.
India's tariff talks with the U.S. will pick up this week with visits from a senior State Department official and a team of American trade negotiators. New Delhi has been eager to finalize a deal with President Trump's administration, which imposed 50% tariffs, partly in retaliation for India's purchases of Russian oil. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how European futures are trading early in the Asia session. We had seen 2 weeks of strength for the euro against the U.S. dollar. A lot to do with the weakness of the U.S. dollar as well, after investors digest that data coming from the United States, including the potential of a rate cut this week. We have also heard from the French President Emmanuel Macron calling for a change in approach to monetary policy at the European Central Bank. Macron is saying that the ECB needs to think differently, and the reasserting the value of the European internal market actually means it can't let inflation be its sole objective, but also growth and employment. JP Morgan CEO Jamie Dimon says Europe is facing a real problem as slow bureaucracy drives out business and innovation. Dimon also told us that the continent's weakness poses a major risk to the U.S.
we have moving tectonic plates. You've heard us spoken about. It's AI. You know, the enemy's in the satellite up above and in your computer systems right now. You know, and the world changed. The other tectonic plate is the rise of China, huge global deficits, social network programs that probably can't be maintained over a long period of time. So Europe has a problem. I think they accomplished an unbelievable thing with when the Euro got together, the EC, and they said, you know, let's live in peace and not war. You know, they had World War I and World War II, but they had the Franco-Prussian Wars, the Napoleonic Wars, the 100 Years' War, the War of the Roses. You know, and so living in peace is a good thing, but it got bogged down. They never finished the common market. It takes 27 nations, you know, to make a decision. They let their military drop dramatically. It's very bureaucratic, which is why part of the reason that, you know, they lost Britain to the EU, which I think makes it bad for both of them, by the way. And so you got to be honest about this. So, and those tectonic plates may move over 20 years. But if we ever write a book about how the West was lost, it will be because of the following. It will be because of we didn't get our act together here, and we go through all the policies here, that we didn't have the strongest military in the world, and that we allowed Europe to fall apart. And so I have a slightly different point of view about Europe. They have some wonderful things, but they've gone from 90% of the GDP of America to 65%. That's not because America did anything bad to them. It's their own bureaucracy, their own costs, they do some wonderful things on their safety nets, but they've driven business out, they've driven investment out, they've driven innovation out. It's kind of coming back. I think the leadership, Merz, Macron, Maloney, Starmer, I think they know. I just think politics is really, really hard. Therefore, the fragmentation of Europe, if they fragment, that's exactly what some of our adversaries want. They want to go back to a world like that, and then you kind of have a world that was like it was before World War I, everybody out for themselves. Everyone's got different national security interests, whether it's food or energy or water, and you know, China is a huge country who wants to do bilateral negotiations with every country. If they fragment, you know, then you could say that, you know, that America first will not be around anymore. It will hurt us more than anybody else because they are a major ally in every single way, including common values, which are really important. So therefore, I think we should be using our American capability, strength, coercion, democracy, trade, investment to urge them to do what's in their own self-interest, which is military and economic, and the economic is equally important.
JP Morgan CEO Jamie Dimon. Now let's take a look at how U.S. assets are faring, of course, ahead of that consequential Fed FOMC, the decision incoming, but also whether we get dissent. Some policymakers think that with inflation the way it is, it might be too soon to be cutting with this 25 basis points. You might also see some outliers in the form of calls for 50 basis points. We are flat when it comes to U.S. stock futures, the dollar, and I suspect this is the way it's going to be all the way until we get the FOMC decision. Shery.
Yeah, and with those expectations over what the Fed will do, we have seen precious metals rallying, but not as much as silver, which has nearly doubled this year. We're seeing a historic supply squeeze in the London market as well, surging demand from India, also silver-backed ETFs. So this is actually outpacing gold. And remember, gold has been hitting fresh record highs for months. And we add also the price of copper, and just a broad metal sector has been really gaining momentum in the last few weeks. Copper also climbing, approaching an all-time high. We continue to see growing demand for electrification and clean energy projects as well. Citigroup also has a bullish price outlook for copper. We have more ahead on the Asia Trade. This is Bloomberg.
Let's take a look at how things are shaping up in Asia currencies, with the dollar still holding flat as we wait for the FOMC. We are, of course, watching some of that firmness coming through on the likes of the yen and the renminbi. The rupee is a different story, but also worth highlighting what is at stake when it comes to the yen, because with the BOJ looking set for a December rate hike, certainly labor cash earnings data in the past hour backing this, the hunt is on for a new carry trade funding source. And this chart shows you how the Swiss franc might be a good one to use given its strong year-to-date performance and the Swiss National Bank's preference for a weaker rate. That's something to consider as we talk FX in Asia. Joining us now is Joew, head of Asia FX Research at HSBC. Joey, always great to see you.
Hi, Avril. Nice to see you.
So when it comes to the yen, and we can talk about the carry trade funding, but what are you expecting in dollar yen first and foremost?
Right. So we are expecting dollar yen to come down. I mean, if you look at the differential between dollar yen and the yield differential, this gap is so wide. It's even wider than it was last year in second quarter going into July last year. And eventually it closed a little bit, right? So I think, we are expecting some kind of closure at some point. It could be triggered by BOJ, it could be triggered by potential intervention if BOJ disappoints, or it could be triggered by maybe the U.S. leg of the story, or it could be triggered by risk aversion in the markets. There are a lot of drivers that could trigger this.
Yeah, so then I guess the question becomes, for dollar yen, is the driver's seat held by the Fed? And is that what's going to cause more of that trigger? How much headspace do you think the Fed might provide the BOJ?
I mean, definitely we think that the Fed will be part of the equation. And it is true, it is our house view and assumption that the Fed will cut and the broader dollar, not just dollar yen, will also go down, not just because of Fed cuts, but also because of the various policy uncertainty that's just coming up in the U.S. in the next coming months, right? And so the dollar, in our point of view, really ought to have a discount to the yield differential, not to mention that the yield differential in the first place is becoming less advantageous to the dollar.
Could we see something of a chaotic unwind like we saw back in July when the BOJ hiked rates?
No, I don't think so, because if you look at the positioning, I mean, admittedly, we haven't really had very updated CFTC positioning data, but still, I think the price action already suggested, right? I don't think a lot of people are, positioned either way in dollar yen. There's been a lot of washouts, be it of long dollar yen or short dollar yen. So I think a lot of people are just thinking quite neutrally and positioned quite conservatively.
Another Asian currency that has been under immense pressure has been the Indian rupee, and we saw the RBI now cutting rates for the first time in 6 months and potentially becoming even more dovish. Does that mean more downside for this currency?
Actually, we don't really think of it that way. So our point of view is that the INR has overshot. Dollar INR has overshot. So the INR has depreciated too much because of the unprecedented tariff stress that he has to go through. And that has led to all sorts of outflows, be it in the form of gold imports or in the form of equity outflows by foreigners. But some of this, could be, potentially just go away naturally. If we do have a tariff rollback, that's one thing. And then the other thing is that also from a seasonal perspective, actually first quarter trade deficit tends to be a bit smaller. It's probably the smallest at any time of the year. So that could also provide a bit of respite in the coming months. As for the RBI's decision, I think it is made on the back of very low inflation. So if you think about it from a real interest rate perspective, it's still very supportive of the INR.
In the meantime, though, RBI might keep having to intervene because the currency is going through a lot of pressure. What are you seeing in terms of FX reserves and the buffers that it has?
Yeah, true. The FX reserves have gone down quite a fair bit. And I think part of the reason for the FX swap might be slightly related to that, just replenish a little bit from that perspective. Of course, there are other reasons as well. But in general, I don't think RBI needs to worry that much about FX reserves adequacy at this juncture. I think for them, it's just about trying to curb speculative pressures, be it from the long dollar INR side or the short dollar INR side.
FX reserves so important for Asian economies that have gone through the Asian financial crisis of the 90s, right, Joey? And one of them, of course, that suffered a lot was South Korea. And its currency right now very much pressured because of all these idiosyncratic news. How much more downside could we see in the Korean won, especially with the outflows coming from U.S. investments?
Right, and the interesting thing about the outflows is that the delta change have actually become smaller. So previously, say the first week of November, we were talking about 5 billion of outflows from foreign investors. That has actually flipped into maybe about small 1 billion of inflows last week. And then similarly for retail investors in Korea, we went from about 2 billion per week for a good 6 weeks or so to just, not just, but 1 billion per week. So the delta change is sort of moving in the right direction to sort of stabilize or cap the upside of dollar Korea. That's one thing. The flows have just become less dramatic and significant. The other issue is also, I think, many market participants are aware that as we get closer to 1480, 1485, that could be when we start seeing more hedging activities by pension fund or other big investors in Korea.
You talk about capping outflows. I think that is a similar dynamic for the renminbi. And when it comes to the thinking behind this for the PBOC, how much further do you think we have to go on that?
Right, so for the PBOC, it's slightly different. I mean, we still see the dollar CNY fixing as going down generally in the trend, right? It's just that the magnitude of the decline has sort of slowed down, right? I mean, to put it quite technically, basically the beta of the dollar CNY fixing to the broad dollar moves overnight has gone from maybe about 75%, so passing through 75% of that change, to maybe passing through 50% of that change, right? So the long story short is that dollar, as long as dollar continues to inch down, then dollar CNY will also inch down. So our point of view is still that we still like dollar RMB lower, and actually we still like we still think that the RMB is one of the more constructive stories and consistent stories in Asia.
Joew, really good to have you with us, head of Asia FX research at HSBC. Let's now turn to India because it's in the midst of a digital revolution that's changing lives, but also exposing citizens to a criminal dystopia. Bloomberg has been looking into the rise of so-called digital arrest scams, tracking down victims and players in potential cases. Senior investigative reporter Natalie Obiko-Pearson joins us now with the latest. What are these digital arrest scams?
It might possibly be the wildest, most elaborate scam you've ever heard of. That's what I first thought when I heard about it. What happens is you'll get a call and they'll say you are implicated in a criminal or case of some sort. The police are about to arrest you in 5 minutes. And the person talking to you on the phone looks like a policeman, acts like a policeman. They've got like a busy police station in the background. They say, you're starting to panic. And they say, okay, but you've got one option. If you want, we can place you under digital arrest. So you use your phone, put yourself under 24-hour surveillance, and we will try and sort this out if you really say you're innocent. And so people are panicking. They will opt for this. Then for days or weeks, they will put themselves under digital arrest. And in the process, they go through fake court hearings. And it goes on. And eventually what happens is they send in all of your money so that we can check that it's clean. You'll get it back if it's found to be clean. And of course, they lose it all. So when I first heard about that, I was like, how can this be happening? And I think one of the things that we were trying to get across to the public was that nobody really understands what these scams feel like until it happens to you. And the psychological methods have become so sophisticated. So what we were trying to do with the story was really get inside a scam and show you how it works. And to get across to people that this could happen to anyone, like to the smartest people.
Does this also reflect something broader about Indian society going through this change in their digital lives?
Absolutely. So one of the reasons we really wanted to tell the story is we're like, it's not just another scam story. It says something about India. And just to take you back a little bit, a bit over a decade ago, India didn't even have a national ID system. So if you wanted to open a bank account, get a SIM card, go for your rations, there was no one recognized way to prove your ID. And then they came up with something revolutionary called the Aadhaar system. And that was a unique 12-digit number for everybody that was linked to their biometrics, your fingerprints and your iris scan. And it 1 billion people got enrolled, and it transformed India. Suddenly it made everything so much easier. Hundreds of millions of bank accounts were opened. A digital payment system came out of that, so everyone's transacting with their phones all of a sudden. You're buying chai on the street or veggies on the street using QR codes. But what happened is, that transformation happened so rapidly that in a way the nation couldn't keep up. Like this new online world where everything is happening over apps and online, and you don't know how to keep yourself safe. And it also became a magnet for scammers.
Natalie, Avril in Singapore here, just wanted to highlight as well. I mean, this is a very serious issue, but your story does read like a sort of novel. Talk to us about who the protagonists and antagonists are in this.
Sure, yeah, and thank you. I'm glad it reads like a novel. That was the intent, because we really wanted to humanize this and show people, this could happen to you tomorrow. So our main victim was a neurologist in her early 40s. That to me was really important. Like, this is not a senior citizen. This is not somebody who's dumb. She was highly, highly acclaimed, very intelligent. Another person involved in this was a poor farmer. So he was just trying to find a job, and they said, here, come with us and we'll set you up for life. What ended up happening was his name was used to open a whole bunch of bank accounts that were used to launder the dirty funds. So now he has been implicated in criminal cases across India. He doesn't even have money to hire a lawyer. And the third principal character, I would call her, is a young woman, ambitious, had a career, and then she got married, and she suddenly had to play the role of a young Indian wife, and she was chafing at it. She was bored. She started joining online cryptocurrency groups, and she was first scammed herself, lost a whole bunch of money, and in order to try and claw back that money, she ended up getting into the underworld herself. So she was trading the money that was coming in from these scams into Tether so that they could be taken away by the scammers.
What are authorities doing about this? How aware are they that this is happening? And are there any government rules or regulations around it? Are they looking into it?
Authorities, of course, are aware. I mean, this particular scam, the digital arrest scam, has just been like an epidemic across India. Like, the cases have just been sort of growing up exponentially for the last 3 years. And yes, I mean, authorities are doing what they can. Like, in this particular case, it was investigated incredibly well. They arrested 18 people, but so many of them are happening that, in a way, it's like there's only so much the authorities can do. For every report they get, there are like 100 that they don't have the resources to chase.
Is really keeping up with that, with the wave of crimes. Natalie, really good to have you with us. Natalie Obiko-Pearson, she's Bloomberg senior investigative reporter, so do check out her story on these digital arrest scams across India. You can find it on Bloomberg.com. Is our first ever graphic novel, so do check it out. More ahead. This is Bloomberg. Take a look at how we're setting up for the market opens across China. A50 futures closed higher for 0.1%. We had seen some gains in the U.S. session on the Golden Dragon China Index, and you're seeing the offshore yuan holding at around that 7 level. And this, of course, coming on a day when we're expecting China's exports data to come out. The expectation is that they likely climbed on year in November after some holiday distortions, and a challenging base drove them down in the previous month. China has won back global funds in this banner year for stocks. Investors anticipating further gains on the country's AI prowess and resilience amid U.S. tensions. Fund managers are expecting this strength to extend through 2026. Our Asia Equities reporter Winnie Su is in Hong Kong with more on this. Winnie, what should we be expecting for the new year in Chinese equity markets?
Yeah, morning, Shery. It seems like there is still a lot of optimism when it comes to the Chinese stocks, especially as we talk to fund managers for the past 2 weeks. We talked to these big names, Man Group, Fidelity, BNP Paribas, you name it. And it's really them betting on how the China's technological advancement is likely to continue to be boosted by that self-sufficiency agenda, and also expectation for a policy to deliver, especially with that the 2 sessions coming up in March and that new 5-year plan to start kicking in. So some expectations around earnings recovery and the economic outlook to improve. However, overall, it's still more likely going to be that slow bull run that we're talking about, especially with Morgan Stanley expecting just a bit of upside around 6% from the current level for the MSCI China, still citing some uncertainty when it comes to geopolitical tensions and also just the deflationary pressure that we're still seeing right now.
So the market expectation of a slow grind high potentially. What are you expecting today, Winnie?
Yeah, so in terms of today and the near term, it still seems to be mostly kind of range bound, especially as we head towards end of the year. A bit of a lack of catalyst when it comes to these boosts in terms of policy. Yes, we do have that Politburo and the CEWC coming up, but that's not likely going to provide a big boost compared to what we're expecting for next year in March. However, today specifically, we are watching tensions closely, especially with Japan and China tensions faring up a little bit more. We've got the defense names in Japan rising already, so keeping a close eye on the Chinese ones. And also the relevant sectors include airlines. We are still hearing that the top Chinese airlines waiving cancellations when it comes to flights for to and from Japan until end of March. And also rare earth is another key area, as we're also hearing from Japanese media that Japanese companies are seeing some delay when it comes to the Chinese rare earth. So it seems like the sectors related to these geopolitical tensions surrounding China and Japan are still quite in focus. And as Shery mentioned earlier, eco data is still that big thing that we're watching. Export data, yes, expecting some rebound, but like Shery mentioned, it seems like it's more of an adjustment, seasonal and also technical, and not so much of a relief when it comes to that U.S. tariff. And CPI data also on watch this week. So we're going to be keeping a close eye to see if we're actually going to see some signs of economic recovery.
Winnie, thank you. Our Asia stocks reporter, Winnie Su. Now, Hong Kong's government says voter turnout in Sunday's Legislative Council election was slightly higher than 4 years ago. The election went ahead less than 2 weeks after a fire at a housing complex killed more than 150 people. Let's get to Hong Kong. Our China correspondent, Min Min Lo, is there. Min Min, what has voter turnout been like, and why is it so important?
Yeah, voter turnout was marginally higher than what we saw back in 2021. It was 31.9% this year. In 2021, it was about 30%, so just slightly higher. And 2021 was the first Patriots-only electoral system that was imposed by Beijing. So this is the second election that we have under that new electoral system. And the reason why we're looking at voter turnout is because it's pretty much the only indicator left to get a sense of voters' engagement. The results have been announced already, and the voter turnout was, I would say, pretty lackluster, considering that the election budget this year has been 50% higher than the previous election. So the government has been spending a lot of money on publicity. They're giving out a lot of discounts and freebies. Every person who voted gets a thank you card, which they can use to exchange for vouchers in shops and restaurants, even for medical services or insurance premiums. And the public swimming pools, the museum, they are open for free as well. And the chief secretary, Eric Chan, said the intention is to create a festive mood to highlight the importance of the election. You can see here the voter turnout is far below the highest level that we saw back in 2016 before the overhaul of the electoral system, and the higher budget that we are seeing as well, currently not getting a lot of public scrutiny. And some ex-lawmakers are saying that outgoing lawmakers are unlikely to ask the tough questions while the incumbents are busy campaigning.
The fire also casting a shadow over the elections. How is it shaping public sentiment?
I would say it is pretty mixed, because there are some people that we spoke to who say that the election is really a civic duty, right, for them to vote whether or not it is delayed or not. Others are saying that because of the fire, they don't have a mood, and certainly the fire has brought a lot of questions to the fore, right, as to whether the government has failed the people, especially when it comes to the inspections, whether they were strong enough, whether rules need to be overhauled. That was the reason why John Lee did not delay the election as well, saying that he needs the partnership of the legislative councillors to change the rules. But on the flip side, because of the government's swift action, they have investigated the fire, arrested more than a dozen people in relation to it. The response, the post-disaster relief had been swift, right? They have identified 1,800 empty apartments for transitional housing as well. All of these could work in favor of the government. And just to underscore how sensitive the fire has been, over the weekend, the authorities summoned journalists from international media outlets, including Bloomberg, warning against any smearing campaign around the fire and any disinformation, which shows you the anxiety for the government. That warning coming just a day ahead of the elections on Saturday. And it shows you that the government was very keen on ensuring that the votes go smoothly without any public disruption. The anti-corruption agency also arrested a total of 11 people over their moves to encourage other people not to vote or to put in a blank vote as well.
Bloomberg's China correspondent Min Lo there. We have more ahead on the Asia trade. This is Bloomberg.
The top corporate stories we're tracking: Netflix's $72 billion acquisition of Warner Brothers expected to face some heavy regulatory scrutiny, as well as opposition from Paramount, which made a competing bid. The historic deal combines two of the world's biggest streaming providers with some 450 million subscribers. Bloomberg has learned Netflix co-CEO Sarandos met with President Trump at the White House in November to discuss the streaming giant's bid, arguing that Netflix isn't a monopoly. Speaking to reporters on Sunday, Trump said the deal could be a problem.
And he's done one of the greatest jobs in the history of movies and other things. He's got a lot of interesting things happening aside from what you're talking about. But it is a big market share. There's no question about it. It could be a problem.
Apple is undergoing its biggest personnel shakeup in decades, with senior executives and key engineers leaving the company. In the past week alone, the heads of AI and interface design have stepped down, as well as the general counsel and head of governmental affairs. We're also told Apple's senior VP of hardware tech, who runs their in-house chips effort, is considering leaving. Shares of Digital Bridge surged Friday in New York after Bloomberg revealed that SoftBank is in talks to acquire the company. Digital Bridge is a private equity firm that invests in assets such as data centers, and sources say a transaction could come together in the coming weeks, though deliberations are ongoing and there's no certainty of an agreement. That's it from the Asia trade. This is Bloomberg.